Well, good morning and welcome to our webinar all around tax and particularly unclaimed tax. We're running this today as a Q&A format, being hosted by David Finn. Hello, David. And David's joined by Ricky, Paresh and Jashma. So welcome to you all. Throughout this half an hour discussion, we're happy to take questions. So please use the Q&A panel on your Zoom toolbar to post any questions you might have to any of our panelists today as we go along, and we'll try and answer as many of those as possible. So at this point, I'm going to hand over to David, and we'll take it from there. Over to you.
Good morning, everybody.
Morning.
Morning, David.
Morning. I feel like a school teacher. Although many of the things to be discussed, you will find that we at RDP Newmans do as a matter of course. Nonetheless, we want to try and give you an awareness of the tools that we can use and some tools that you may not yet have heard of, but which may be relevant going forward, etc., to reduce your tax liabilities. Yeah. I am reminded of the fellow that went to the accountant, and he was a difficult fellow, and the accountant, apparently this is a true story, and the accountant knew he was going to have a tough time. He had a big tax bill, and he said to the accountant, "What's my tax bill?" He said, £100,000. It's too much, see what you can do. The accountant scratched his head, said, "I really don't know what." He said, "Let me think about it, I'll come back to you." 2 days later, he came back. "I've managed to reduce it down to £80,000. He said, "You're a miracle worker, that's marvellous, absolutely marvellous." Anyway, his secretary was struggling with this, and he said, I don't understand. Why did you tell him his tax bill was £100,000? He said, "The tax bill was always £80,000, but he always wants a deal. So if I could reduce it down to 80, he was happy." We're talking about true tax liabilities. We're not talking about exaggerating. Okay, perhaps we can kick off by introducing my partners, Paresh and Ricky, and our senior tax manager, Jashma, who will guide you through this little section. Okay, let's start off, guys, talking about personal allowances. Ricky, kick off. What we're looking for at personal allowances, what do they mean, and tricks that we can use with them.
Thank you, David. Good question. Starting with basics, everybody gets a certain amount of income tax-free. Sounds great. So for an individual, that's £12,500. That is supplemented by further allowances, David. So married couples, if one taxpayer's basic rate, the other one has income below the basic personal allowance, one's allowed to transfer 1,250. So that's a tax saving if you're a basic rate taxpayer, 20% of the 1,250, £250. The revenue do also give other allowances in certain circumstances. There's a blind person's allowance of 2,500. And then there are special allowances around savings and savings income and dividends. So the first £2,000 of dividend income is tax-free. The first £1,000 of savings income is tax-free for a basic rate taxpayer. £500 for a higher rate taxpayer. So in broad terms, once your income hits 50,000, you're into the higher rate banding. So I mean that's it in very broad terms, David. In terms of
lovely. I mean, you've given us sort of the headlines there, Jash. What can we do with this? How can we use these allowances to save people tax?
It would be a very good idea for a client to really actually, if they've got investment income, and if you got
what is investment income? Can we define
investment
that?
Income, if you got savings, but for example, a couple may have savings, and a lot of times a thought has not been given to whether those should be held jointly or in individuals' names. And there are times that historically they just have put in one partner's name and not thought about shifting the savings around, because obviously the new tax-free bands which came in a few years ago, where you can get £500 for a high rate taxpayer free, which is taxed at 0%, and for a a lower rate payer, £1,000, that should be fully utilised. If sometimes thought is not given, you should look at maybe splitting the savings up to make it obviously more tax efficient.
So if we've got a higher rate taxpayer who's got earned £1,200 of interest on his bank account,
yeah,
he will be paying more tax than if we had two lots of 600.
Exactly. If it's split up with his spouse, then that would be a tax saving there. The other thing is obviously for the lower basic rate payers who may not have a lot of other income except maybe state pension, but they do have a lot of money in savings, they get additional £5,000, which is tax-free as well for interest. So that's actually quite substantial. I mean, if you tax plan it right, you could actually end up having each couple be able to earn up to about £16,500 to £17,000, which is tax-free, utilising all your personal allowances and your zero rate bands.
Okay, fine. But talk about dividends. Paresh, what can we do with dividends? I mean, is it a similar story?
Yes, it can be. I'll just go back to one point Josh Mayer was making on the savings. One thing to consider is where you have an owner managed business with a limited company and you do have a high director's loan account, individuals can charge the company interest to utilise their £1,000. There's a bit of planning around that, but again, it's a tax deduction in the company and tax-free in the director's hands as well. So that's also worth just considering on the savings allowance.
Can we run an example on that, sort of just sort of in global terms, what we got?
Yeah. So if you have a husband-wife company and you're voting dividends, or income which is not fully drawn, or the couple have invested in the business, and the company owes them a sum of money, and if it's there for sort of medium to long term, then both of them can charge. If they have no other savings income outside of the company, they can charge the company interest, say £1,000 each if they're both basic rate taxpayers. The £2,000 is going to save corporation tax because it's deductible, and in their hands it's tax-free. So not only do they get £1,000 tax-free, the company also saves corporation tax. It doesn't really work well for short-term directors' loan accounts because the paperwork behind that can be a little bit onerous, but if it's there for medium to long term, I usually recommend that that's worth considering.
Obviously, that would have to be sort of a commercial rate. You can't charge £1,000 interest on a £500 loan.
Yeah, no, it has to be commercial and arm's length, etc., etc. So for sort of substantial loan balances, it's worth considering.
Fine. I've got a question.
Yeah, I step in on that point, David.
Sure.
Because I think Paresh just mentioned £1,000, but actually paying interest on your loan credit balances from company is beneficial anyway. If you wanted to try to maximize the drawouts from the company and obviously minimize the tax, and one of the routes we always opted for is if you've got a hefty balance in the loan account, then do pay as much interest as you can, which would be at the rate which is acceptable revenue. And it actually works out cheaper than drawing out dividends sometimes.
Okay, good to know. Okay, what can we do with dividends? Is the way of splitting dividends? Do we get any benefits by splitting dividends between husband and wife?
Shall I step in on that one? I think not as much as it used to before, because now the tax-free bands are only £2,000 each. It's still worthwhile doing it at times, but splitting it too much and maybe putting through a lot of paperwork at times does not justify it, because it doesn't really save that much tax if you've got to split the shareholding into more than two people.
Okay.
But yes, that's definitely the £2,000 which is available, which is tax-free. But it does eat into your basic rate band. You must bear that in mind.
Okay. What would
I think also, sort of interrupt you, Dave, but where dividends and the use of a company can be helpful is where income levels vary year on year. Obviously, some clients may not appreciate company profits are taxed at 19%, whereas in an individual name you're into 20%, 40% for higher rate taxpayers and national insurance on top. Now, where income is varying year on year, you can suffer the corporation tax only, and defer, if you're able to defer drawing out funds, smooth that tax charge over a number of tax years to use allowances in more than 1 year. So, you know, the use of a limited company as a wrapper around the business is essentially great, not just from a tax planning perspective, but also from a commercial perspective in terms of mitigating risk.
Before we move on from this subject, there is a question that's come in. I'll read the question. Does the spouse tax allowance, can the higher rate taxpayer make a claim on this? I think we're referring there to the marriage allowance. Can the higher rate taxpayer claim the marriage allowance?
No, they both have to be, the other spouse has to be basic rate payer, and obviously the other, one of the spouses has to have underused personal allowances.
Lovely. Okay, hope that answers your question. I mean, let's move on. So we've spoken very, very loosely about personal allowances. What about the different tax rates? Is there any tax planning strategies we can use around the individual rates, the basic rate, the higher rate, or the very high rate? Is there any tax planning we can do there certainly between a couple, husband and wife, or partners?
I'll start off on that one. If the couple is claiming child benefit, then the clawback for the child benefit starts if either of the spouse starts earning more than £50,000. So if you can actually, if they're in that position and joint income is, say, below 100, but one of them happens to earn about 60, 70, then they'll lose that child benefit. So it may be worthwhile then tax planning such that each of the couple actually retains threshold below 50K. So that can be tax planning too, how you structure the remuneration.
Okay. Okay, let's move on to sort of a related issue. Capital allowances. This might be something that's more relevant for businesses rather than individuals.
And in fact, before you move on to capital allowances, just one more threshold that needs to be watched out for. If taxpayers are going to go above the £100,000 in their total incomes, then they start actually losing their personal allowances. So if you could be a case where one of the spouses actually income does go above the 100K, at that point actually you're paying a marginal rate of 60% tax. So if you can then again tax plan where you try to keep both of them under £100,000, that would be another threshold to look out for.
Good, thank you. Thank you for that. Okay, moving on, capital allowances. Who wants to kick me off on that one, Parish? Perhaps we can have just a description as to what capital allowances are, and then we can look at some of the details which may be relevant.
Yeah, sure, David. Very briefly, if a business, and this could be limited company and obviously partnerships and sole traders as well, using an asset in their business, then there is a write-off of the cost of that asset against their profits. So what we're talking about is things like plant and machinery, computer equipment, software, fixtures, fittings, desks, chairs, etc. Anything that goes into making up, you know, the asset side of the operation of the business. The rates that apply to this are depending partly on the type of asset that we're talking about. So for most capital equipment like plant and equipment, you get 100% write-off in the year of the purchase of the asset. This can be up to a maximum of £1 million for small businesses. This threshold will, as it stands now, go down to £200,000 from the 31st of December 2020. So if anybody is planning on incurring any capital expenditure, then anything before the 31st of December would be you know, a good idea to make sure that they get the full tax relief. There has been talk about the budget, which is pending, that, you know, there was going to encourage investment. This may get reviewed, but as things stand at the moment, the £1 million will drop to 200 in December. In addition to that, you get writing down allowances on any other assets which are in excess of that you can't claim the IIAs on, which runs at 18%. And there's also a 6% rate for special pool. Cars do not qualify for AIAs unless they fall into certain CO2 categories and or are electric cars. Then there are write-offs available in those circumstances. But broadly speaking, cars won't qualify for any enhanced capital allowances. And these allowances will remain there as part of your tax deduction until either the asset is sold or the business ceases to trade, and any under and over claims are adjusted at that time.
Okay. So Parish, what you're saying is really, if you're thinking about having major investment in assets, do it before 31st December. Yeah. And when buying a car, if you want to be most tax efficient, the green cars may be the way to go.
The way to go, absolutely.
Okay, good. One thing that is sort of very exciting, I know we've dealt with it in the office a few times, is this research and development.
Yes, before you move on, David. Sorry, with capital allowances, I think the major thing which to watch out for actually is if you've got clients who are proposing to purchase properties, properties actually have another allowance which is you can claim, which is called the integral allowance, features allowance, which actually is part and fixtures of the building, but it's a special allowance which can be claimed. But with the rules which were changed a couple of years ago, you can only claim those if that clause about capital allowances has been included and you have negotiated with the people you're purchasing the property from the right clause about how much you can claim. So it's very important to actually talk to your accountant before you sign any contracts on purchasing commercial property. And that's really something it can actually be worth substantial money, which will be lost if you haven't negotiated it and included it as part of your contract or purchase.
It's actually a very good point, and as you know, and we as a firm have engaged specialist surveyors and to look at such transactions, and they will identify any allowances that are claimable by the purchaser. So it's always worth considering that prior to completing the purchase.
And it's a good point, Jash, because normally a property is a substantial amount of money, and these claims can be worth tens, if not hundreds of thousands of pounds. So depending on the value of the property.
If that hasn't been quantified in your contract or included, then actually those allowances related to the building, the property can be lost forever, not just to you, but any future buyer. Thank
you for that. Very valid point. Now, I know something that excites you, Jashma, research and development. Ricky, kick us off, and then we can perhaps sort of have some case studies as to the type of things we've done with clients in terms of this R&D, research and development claim.
Yeah, look, in very broad terms, David, R&D claims allow an enhanced write-down, significantly enhanced. One can claim 130% of qualifying expenditure on top of the expenditure itself against profits, where R&D activity is undertaken. Now, R&D, people have this image of, somebody in an ivory tower with a white coat on. It's a lot more broadly applicable than that. So, we've got clients who are producing food supplements, clients in restaurants, different industries who have claimed R&D successfully. The actual activity itself is fairly tightly defined in terms of what qualifies. You need to look at advances in technology, processes around advancing understanding and knowledge. It needs to be a process that's usually a project rather than a finite short piece of work. But it does, as you say, allow some very interesting opportunities, not just to reduce tax, but where clients who are in early stage development to allow credit where they wouldn't be taxpaying.
Josh, how's it work? Tell us some numbers.
Yeah, the way it works is that if you have a project which you think you can get classified as R&D, you get uplift on expense of 130% on that particular amount of expense. So you can claim that much additional expense on your computation as a deduction in the year in which you incurred it. So this could actually then eventually even result in either reduction in corporation tax liability overall, or if you actually end up making losses because of your R&D uplift expense, you can, as Ricky mentioned earlier on, you can actually claim a tax credit, R&D tax credit, which is worth at 14.5%, which is quite substantial, because if the company is involved in this sort of work for the first few years on an ongoing basis, and they can actually cash in on those losses, then it's worthwhile, because the tax rate is 19% anyway. Obviously, if you're expecting to make profits in the near future, you rather carry those losses forward, because then the tax savings at 19%. But if you haven't, then cashing on at 14.5% is actually a pretty healthy sum to get back from the revenue.
So how do we work out this 130%? What's it based on? I mean, 130% of what?
It's a sort of cost. Like if you're saying you're running a project and you got a number of people involved, the main sort of cost you can claim on R&D is to do with actually salaries. So the number of people involved and the time they spent on projects, you would claim a proportion of that. And it's just not the salaries, it's the employers' national insurance contributions proportion, as well as the pension contributions which they make on the behalf. So you would actually classify those as your R&D costs. The other costs which you could claim are not that much. Direct consumables you can claim. If you're involved in a project and you have to buy products which help to the R&D project you're carrying on, that would be obviously claimable as well. With overheads, it's quite restrictive. The only thing which you can claim is if you're running a part of a facility of your manufacturing base or something where you run light and heat, you've got extra costs and those can be claimed. So you would actually get 130% uplift on that total amount as an additional expense. So if you've got expense of 100K, which is R&D, you'd get another 130% on that.
One of the audiences asked, is there a definition of research and development?
There is. I haven't got it in front of me. I don't know if you have it, David. I think it's an advancement. I actually haven't got my note in front of me.
I think in broad terms, they're actually looking for an advance in science and technology. They're also looking for projects that have to overcome uncertainty in the field and a demonstration of how you've done that. So, you know, it's almost got to be something that's not part of the day-to-day work, but a larger, more defined project. Now, it is a specialist area, and I think each case needs to be looked at on a case-by-case basis. But it does hinge around advances in science and technology.
Good. What about are there any other reliefs similar to research and development?
There is. I mean, you got the patent box relief as well.
Okay, tell us what that is.
Okay, that is if you're actually involved in a business whereby you have actually either purchased patents which you then use in your manufacturing process or product production, or you actually are involved in doing research and then patenting whatever you have research as a process, or it could be equipment or whatever it is, that if you then produce sales based on that, you can get a reduction in your corporation tax. In that, you'd pay 10% corporation tax on that revenue stream, rather than the 19% which you normally would do as corporation tax. So once that process, the patent has been successful, then obviously there are further savings. You could actually claim both together, because while you were doing the process and trying to get this new process established, you'd be claiming R&D. But once you start then putting this on the market and you start generating revenue, then you're able to claim the patent box, which would be then a 10% tax rate.
Okay, and what about, if you've got somebody that's got a grant to develop something
You have
from the government, how does that work how does that interplay with R&D?
In fact, it's quite an important play, because if you're getting a government which is regarded as a state-aided grant, you have to be very careful when you're thinking of applying for it at the onset of your project or whatever you're contemplating doing. Because if you get that grant, which may not be substantial, it may deter you then having to claim, you won't be able to claim R&D, because a small company and medium company R&D is also regarded as state-aided funding. You're not allowed to claim state-aided funding on the same project from both the sources. So then you have to actually think carefully which one is going to be more beneficial for you. And unfortunately, the way the process works, if you already applied for it, you may not then agree to take the grant, but the fact that you applied for it actually is already putting you in that bracket where you then won't be able to claim the R&D related to the project.
Can you think, there may not be an answer to this, but can you think of any wacky things that our clients have developed where the listeners may not think it's R&D?
I've got one actually, David. I've got a client who manufactures brushes, and you would think initially that there is no R&D claim to be made around the manufacture or design of brushes, but there are. There are certain things you can actually sort of do research on, like materials, renewable materials, recyclable materials, etc., etc. And there's a demand in the marketplace for such products, and they were successful in making a claim.
Very good example. Thank you.
Yeah,
Thank you.
we got one where we got a client who actually is involved in the design industry, and actually do designing for the aviation industry. So in this particular company, it has actually involved in the designing and helping with the first class seating in airplanes. And what they come up with is, the research they do is to try to come up with much more lighter material, or which obviously will stand the pressures or whatever it is when you're up in the air, and doing work like that. And obviously design part of it as well, to make it more space efficient. And that company successfully claimed R&D.
Very good. Good. One final point. I can see the clock is against us, and we've got 1 minute left before we move to questions. Directors' loan accounts. Good thing, bad thing. Can we use them? How can we use them? First of all, let's explain what a director's loan account is. If an individual has injected money into the company and hasn't taken it back, it stands to his credit in what's called a director's loan account. So are there any tax planning opportunities using director's loan accounts, splitting, maybe we've covered this before in personal allowances, but are there any planning opportunities, how to repay that money or how to take money out of the company? Parish?
Yeah, I mean, just directors' loan accounts are typically very common in owner-managed businesses, because owner-managed businesses usually view the business as an extension of their own sort of working practices or lifestyle, and they draw money from a company. So this usually results in either an overdrawn director's loan account or an operation of a director's loan account, which interacts with some of the other taxes we've talked about earlier, which is dividends and or drawing a salary and utilizing personal allowances, etc. And the director's loan account is usually used as a sort of the account where everything is sort of accounted for. Now, particularly in this COVID-19 situation, we do find that directors who have businesses, particularly if they're having a sort of a rough patch at the moment, directors are drawing monies from the businesses, and typically maybe in previous years they've topped it up with dividends or income. They may be sort of looking at a situation which is not so easily achievable this year, so they end up in an overdrawn loan account. So this, under sort of company law, is actually illegal and is not allowed. And secondly, from the tax perspective, this also has an impact because this is also not allowed. And we usually try and rectify this in sort of one or two different ways. One is we try and mitigate any tax issues arising at the end of the tax year. We make sure there's a provision for interest that the company charges the director, so no benefit in kind charges arise for having that loan account. And secondly, there is an opportunity post the year end for the company to either vote dividends or salary to the director, or the director injects cash in to try and rectify that position within 9 months of the year end. If this is not done, then it's called a Section 455 tax charge. The revenue will expect the company effectively to pay like a tax bond on the overdrawn loan account, dependent on the director's tax rate. So it could be either 32.5% is a typical amount that gets charged. The revenue will hold on to that tax bond for a year after the loan account has been rectified, either repaid or again cleared through dividends or through salary. Sometimes it's a deliberate act. Some directors will overdraw their loan account, and knowing that there are some tax consequences around that. Where I've seen this operate sometimes is when a business is about to be sold, and rather the director drawing out income at higher rates, what they tend to do is they wait for, and this is typically for a trading business, they will actually run an overdrawn loan account, and as part and parcel of the sale, once the shares are sold, they get their money onto the when they get some money into their hands, they repay the loan account within the 9 month stipulated period. So effectively, they've got money out at a cheaper rate. However, you have to be careful. The revenue will look at this if they think it's deliberate, etc., etc. They may review that situation. But I have seen that operate in businesses where we've not been the seller, but we have been the buyer. So yeah, so director's loan account is an important tool that can be used to buffer, again, the point that Ricky made, buffer sort of the spread of income from a company to an individual, just to even out an income stream to enable, you know, the best tax positions to be obtained for the taxpayers.
Great, thank you for that. I'm going to throw it open to questions. We've got one outstanding question which I'll throw over to the panel, and then if anybody else has got questions, please do post them on the Q&A section. A question here: bank interest is paid gross. Should we be filling a tax return for personal tax just for that interest? Josh?
No, you don't have to. You can actually ring up the revenue to tell them about your bank interest figure. They'll adjust it pre-coding for you.
Okay, so no need to do a return. Lovely. Any other questions from the audience? No, seems to have gone quiet. Okay, so we'll wrap it up here. There are other taxes on which savings can be made and which planning opportunities exists, including inheritance tax, which is perhaps where the bigger savings can be made, but that really is a subject in its own right. Inheritance tax is payable on death on somebody's estate, and there can be, with good, inheritance tax is possibly the only tax that you can eliminate altogether with proper tax planning. But that is a subject in itself, and if there is interest, we will be delighted to put on a separate webinar just covering inheritance tax. On behalf of all of us at RDP, thank you, enjoy your day and stay safe. Thanks very much indeed.
Thank you.
Thank you.